Welcome to my channel. Please like, comment, and subscribe. Bank interest is here the definition, types, function, and benefits. Bank interest is a term in the banking world that is quite popularly known by the public. This term refers to a form of remuneration provided by the bank to its customers. However, it can be interpreted differently depending on the point of view. In this case, the point of view in question relates to the definition of the type of bank interest itself, namely deposit interest and loan interest. Broadly speaking, the difference between these two types of bank interest lies in the right and obligation of the customer. You may be wondering what that means, right? For that, let's discuss further that what bank interest is along with its types, function, and benefits. What is bank interest? Quoting from the big dictionary, bank interest is the interest rate or rate that is justified by the bank on borrowing money. Meanwhile, the Financial Service Authority or OJK defines bank interest as a number of form of compensation given by bank to customer for fund deposit in bank. These two meanings emphasize that bank interest has different meaning depending on what the customer does, whether it is saving money or borrowing money. If the customer save money, the bank interest received is in the form of right that must be paid by the banks, where this is indicated by the addition of interest on the deposit from the calculation of the accumulative saving of money it has. On the other hand, if the customer borrows money from the bank, then he has an obligation in the form of returning the loan form, which can be paid in monthly installment and added with a certain percentage of deposit interest. So it can be concluded that bank interest is remuneration in the form of the price that must be paid by the bank to the customer who has deposit and the price that must be paid by the customer to the bank if he gets a loan. Bank interest rate types. In general, bank interest is divided into credit or loan interest rates and saving rates, each of which has been briefly explained previously. Furthermore, OJK explained that bank interest rates were further broken down into 5 different types, namely 1. Fixed interest rate. Fixed interest rate is a type of interest rate whose fees are fixed and do not change until the maturity date. So even if there is an increase or decrease in interest rate in the market, the amount of interest you have to pay does not change. Some examples of the use of fixed interest rate are the People's House Loan or KPR, cheap home or subsidies, home and motor vehicle loans. 2. Floating interest rate or floating. In contrast to fixed interest rate, floating interest rate always change according to the market interest rates, where if you like the interest in the market to rise, the interest rate that must be paid also goes up and vice versa. An example of a floating interest rate is a mortgage for a certain period of the time, where the first year will use a fixed interest rate, then the next year using a floating interest rate. 3. Flat interest rate. The flat interest rate is an interest rate whose calculation refers to the initial amount of the loan principal and is divided proportionally for each installment period. How to calculate it is relatively simple compared to other interest rates. So generally, this interest rate is used on short-term loans for customer goods such as collect household applicants, and use unsecured loans or KTA. The formula for calculating is the flat interest rate. Interest per month, initial loan principal, interest rate per year, number of year of credit term, number of month of credit tenor. Thank you for watching this video. Don't forget give, like, comment, and subscribe